In this video, I would like to discuss, beginner's guide to different stock investment accounts, different stock market investment accounts. When it comes to investing in the stock market, you have different kinds of accounts, and that's what I want to analyze in this video. Number one is brokerage accounts. I think it's the most common, the brokerage accounts. So this is a standard account for investing in stocks, exchange traded funds, and other securities. So in this case, there's no contribution limits or restriction on withdrawal. It's subject to capital gain and income taxes. So it's best for flexible, short-term, and long-term investment, long-term stock investment. So in this particular account, you are exposed to capital gain. Your capital gains will be taxed. You could use this account to buy stocks, to buy exchange traded funds and other securities in the market, and it's quite flexible. It is good for short term as well as some long term investments. This is the kind of account most investors have, and it is maintained by your brokerage house or your stockbroker. Number two is an individual retirement account, the IRA, the individual retirement account. This is a kind of tax advantage account. It is meant for retirement. I think I have one. I have one with IBTC, Stanbic IBTC pension administrators. So you can invest in stock within an IRA. In other words, your administrator can even help you invest in stocks. They invest in stocks and other securities. Consider other investment vehicles, and they are tax advantaged, kind of. So you have your traditional IRA, the traditional investment retirement account. It is tax deductible. It is there's this particular when you withdraw funds from the account, you could be taxed. But in our own case, we don't withdraw any amount until when we retire. So it is there's a tax deductible contribution, and of course, upon withdrawal, you will need to pay tax. There's the Roth IRA. This after tax contribution, tax-free withdrawal on retirement. This one is tax-free. When you withdraw your money, you don't pay tax. It's best for retirement-focused investors seeking tax benefits while investing in stocks. You want to have that tax benefit while you invest in stocks. You don't want your withdrawal to be taxed. Then you invest in this instrument. Number three is a Roth IRA. The Roth IRA here, contributions are made with after-tax income, with a tax-free withdrawal on retirement. So when you withdraw your money at retirement, you don't incur any tax. It's ideal for long-term growth, for tax-free withdrawal, and there's no required minimum distribution. It's best for investors expecting higher taxes in retirement. You don't want to be taxed when you retire, and you go for Roth IRA. The withdrawal is tax-free. It's tax-free because your contribution in the first instance is an after-tax contribution. You contribute after tax, but when you withdraw, it doesn't incur any tax implication. Number four is the 401k plan. The 401k plan is very popular with employees. So employer-sponsored retirement account that allows stock market investments. So the contributions are tax deferred, and employers may match their contribution. In my own case, my employer is the federal government of Nigeria, so they match my contribution. But they even pay a little bit higher than what I contribute. It is not 50-50. It looks like something like either 60-40 thereabouts. I can't calculate precisely, but their own contribution is a bit higher than mine. So they match my contribution. It's best for employees looking to invest in the stock through retirement savings with potential, employer contribution. Essentially, these administrators, the pension fund administrators, they invest in stocks and they adjust your stock holdings based on your age. They have different classes of fund: fund A, fund B, so the fund 1, fund 2, fund 3, fund 4, like that. So each of these funds operates based on your age. So as you get older, they keep on shifting you from into other funds that have lesser risk. Number 6 is SEP IRA, that's simplified employee pension. Simplified employee pension, SEP IRA. It's a retirement plan for self-employed individuals and small business owners, offering a kind of higher contribution limits than the traditional IRA. So in this case, contributions are tax deferred. It's best for self-employed individual or business owners looking to invest in stock for retirement. In this case, those who are business owners and they want to save for their retirement, they can invest in a SEP IRA. They are basically investing for themselves as self-employed individual. There's a Roth 401k plan. So it's a kind of 401k where contributions are made after tax with tax-free withdrawal in retirement. So employers may match contributions. It's best for employees who want tax after tax contribution and tax-free growth in retirement. It's quite similar to the typical 401k plans. Number 7 is a simple IRA. That's a saving incentive match plan for employees. Simple IRA. Savings incentive match plan for employees. So this involves it's a kind of retirement plan for small businesses where both employees and employers can contribute. They can contribute like their contribution is tax deferred. It is tax deferred, kind of with lower limits than your typical 401k plan. It's best for small businesses and self-employed individuals seeking a simple retirement plan with stocks, with stock market intervention. It is for small, is for small business owners and self-employed individuals. So in this case, you discover that your employer can equally match your contribution. It's meant for small-scale businesses. Number 8 is custodial accounts. Custodial account. So in this kind of account, you discover that the account is there for is set up by a custodian for minors where stocks can be invested. Parents can do it for their children. You want to introduce your child to stock investing, you can open a custodial account for your child. So the minor gains control of the account at the age of at a certain age, maybe 18 years or so. The child can gain control of the accounts. So it's best for parents or guardians investing in stock for their children. You want to invest in stock for your children, you can open a custodial account for them. You manage the account for them until when they grow up, they understand the market, they can trade and invest for themselves. You hand over the account to them. Number 9 is a joint brokerage account, just like a joint account. It is an account, between two or more people, often by spouse or business partners. You and your wife can have a joint brokerage account. You can buy and sell shares. You can manage your investment in stocks. You know, it's best for couples, for partners, and for those who are in a business partnership together who want to invest in the stock market. Number 10 is trust account. So investment account managed by a trustee on behalf of the beneficiary. So you open what is called a trust account. Stocks can be held in a trust, and the trustee follows specified instruction on how to manage the accounts. It's best for estate planning and ensuring investment are managed and distributed as intended. Somebody can, maybe as part of his will, may leave some money for his children in a trust account, what is called trust fund babies, that kind of a thing. So they manage this fund on behalf of the trustees manage this fund on behalf of the 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 children or the individuals or the individual concern. So each account type offers unique benefit based on your financial goals. Like when it comes to taxation and investment strategy, the right choice depends on your investment horizon, your tax preferences, as well as objectives, such as retirement or estate planning. That will determine the kind of account that is most suitable, for your need